Question 9. What are the key risks associated with the lithium ETFs investment strategy? Lithium ETFs offer exposure to the lithium and battery technology sector, which holds promise for future growth. However, this specific investment strategy also comes with inherent risks. Here's a breakdown of the key areas to consider. Sector concentration. Limited diversification. Unlike a broad market ETF, a lithium ETF focuses on a specific sector. This means your investment is heavily tied to the fortunes of the lithium and battery technology industries. If these sectors experience a downturn, the value of your ETF could decline significantly. Dependence on electric vehicles and renewables. The success of lithium ETFs hinges on the continued growth of electric vehicles and the adoption of renewable energy solutions. If these trends stall or reverse, companies within the ETF could suffer. Commodity price fluctuations. Lithium price volatility. Lithium is a key element in batteries, and its price can fluctuate significantly based on supply and demand dynamics. If lithium prices fall, it could negatively impact the profitability of mining companies within the ETF. Other input costs. The production of batteries and electric vehicles relies on various materials. If the prices of other key inputs, like cobalt or nickel, rise substantially, it could squeeze the margins of companies within the ETF. Technological disruption. Battery technology advancements. The rapid pace of innovation in battery technology could disrupt existing technologies. If new battery types emerge that don't require lithium, companies within the ETF could become obsolete. Alternative energy solutions. While lithium-ion batteries are dominant now, alternative energy storage solutions could emerge and gain traction. This could undermine the long-term growth potential of the lithium and battery technology sector. Additional risks. Geopolitical issues. Lithium resources are concentrated in a few countries. Geopolitical instability in these regions could disrupt supply chains and impact lithium prices. Currency fluctuations. Many lithium mining companies operate outside the U.S. If the U.S. dollar strengthens significantly, it could reduce the value of their earnings when converted back. Question 10. Does lithium ETF contribute to portfolio diversification? A lithium ETF can contribute to portfolio diversification, but it depends on how you define diversification and the overall makeup of your portfolio. Here's a breakdown of both sides of the argument. Arguments for diversification. Sector exposure. A lithium ETF provides exposure to a specific sector, lithium and battery technology, that might not be well represented in other holdings within your portfolio. This can help spread your investment risk across different industries. Growth potential. The lithium and battery technology sector is anticipated to experience significant growth due to the rise of electric vehicles and renewable energy. Including a lithium ETF offers the potential for amplified returns compared to broader market investments. Arguments against perfect diversification. Limited diversification within sector. While a lithium ETF offers exposure to a new sector, it doesn't necessarily provide perfect diversification within that sector itself. The ETF might hold companies primarily focused on lithium mining or battery production, lacking diversification across different segments within the lithium and battery technology space. Correlation with technology stocks. There might be a correlation between the performance of lithium ETFs and technology stocks in general. Since electric vehicles and battery technology are seen as innovative and future-oriented, their performance might be tied to broader technology sector trends. Overall impact on portfolio diversification. Depends on portfolio composition. The extent to which a lithium ETF contributes to diversification depends on your existing holdings. If your portfolio already heavily leans towards technology stocks or other future-oriented sectors, adding a lithium ETF might not provide significant additional diversification benefits. Complementary exposure. However, if your portfolio is heavily weighted towards traditional sectors like financials, energy, or consumer staples, a lithium ETF can offer valuable diversification by introducing exposure to a high-growth sector with distinct drivers. Question 11. Are there other ETFs with similar objectives of lithium ETF, but lower expense ratios? Yes, there are several ETFs with similar objectives to the lithium ETF, LIT, but potentially lower expense ratios. Here's a breakdown to help you compare. Similar objectives. Lithium and battery technology exposure. These ETFs aim to track indices focused on companies involved in the lithium and battery technology sector. This provides investors with exposure to the potential growth of this sector driven by electric vehicles and renewable energy. Lower expense ratios. Expense ratio. This is an annual fee charged by the ETF to cover its operating expenses. A lower expense ratio translates to a higher portion of your returns staying invested within the ETF. Here are some popular options to consider. iShares Global Lithium Battery Tech ETF, BLDR. This ETF tracks the iShares Global Lithium Battery Tech UCITS ETF, Battery Technology UCITS ETF, offering exposure to a basket of companies across the lithium cycle, from mining and refining to battery production and recycling. BLDR generally has a lower expense ratio compared to LIT. VanEck Lithium Battery ETF, BAT. This ETF tracks the MVIS Global Lithium Battery Index, which includes companies involved in lithium mining, refining, battery production, and electric vehicle manufacturing. BAT also has a lower expense ratio compared to LIT. Important note, expense ratio is just one factor to consider when choosing an ETF. Here are some additional points for comparison. Underlying index. While all these ETFs target the lithium and battery technology sector, the specific companies they hold can differ depending on the underlying index they track. Research the index composition to understand the specific areas each ETF emphasizes, e.g., mining versus battery production. Liquidity holdings. Some ETFs might have lower trading volume, liquidity, compared to others. This can affect your ability to easily buy or sell shares. Additionally, compare the number of holdings within each ETF. A higher number of holdings generally indicates broader diversification within the sector. Past performance. While past performance isn't a guarantee of future results, it can be informative. You can compare the historical returns of these ETFs to get a sense of their performance volatility. Question 12. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, it's possible to achieve a similar outcome to a lithium ETF, LIT, with a combination of individual stocks or other ETFs, potentially offering lower costs or greater control. Here's a breakdown of the pros and cons of each approach. Lithium ETF. Convenience diversification. Lithium ETFs offer a convenient way to gain exposure to the lithium and battery technology sector with a single investment. They hold a basket of companies, providing some built-in diversification within the sector. Lower costs. Compared to individual stock picking, while ETFs have expense ratios, they can be more cost-effective than buying individual stocks due to economies of scale and potentially lower trading commissions. Limited control. Investors have no control over the specific companies held by the ETF. The composition is determined by the underlying index. Individual stocks. Greater control. By selecting individual stocks, you have complete control over which companies you invest in within the lithium and battery technology sector. You can choose companies based on your specific research and investment criteria. Potentially higher returns. and risks. Individual stock picking offers the potential for higher returns if you select the right companies. However, it also carries the risk of significant losses if a company underperforms. Higher costs. Trading individual stocks can incur higher commission fees compared to investing in an ETF. You'll also need to dedicate more time and effort to research and manage your individual stock portfolio. Alternative ETFs. Broader sector exposure. Several ETFs focus on clean energy or technology sectors, which might include companies involved in lithium and battery technology alongside other relevant industries. This can offer broader diversification while still providing some exposure to the lithium and battery space. Lower expense ratios. Potentially, some alternative ETFs might have lower expense ratios compared to LIT. However, this depends on the specific ETF you choose. Less control. Compared to individual stocks, like lithium ETFs, you don't have direct control over the individual companies held within these alternative ETFs. Question 13. What are the pros and cons of this lithium ETF compared to similar options? Here's a breakdown of the pros and cons of a lithium ETF, using the popular Global X Lithium Battery Tech ETF, LIT, as an example, compared to similar options. Pros of LIT. Well-established reputable issuer. Global X is a well-established issuer with a proven track record in managing ETFs. This can provide investors with confidence in the quality and transparency of the fund's operations. Tracks a broad index. LIT tracks the sole active global lithium index, which offers exposure to a wide range of companies across the lithium and battery technology sector, from mining and refining to battery production and recycling. This provides some built-in diversification within the sector. Relatively high liquidity. LIT is a popular ETF with a high trading volume. This translates to easier entry and exit for investors, as you can generally buy or sell shares quickly and efficiently. Cons of LIT. Higher expense ratio. Compared to some alternatives, LIT has an expense ratio that might be higher than some competing lithium ETFs. While expense ratios are generally low for ETFs, a slightly lower expense ratio can translate to a higher portion of your return staying invested within the fund over time. Limited control. Like all ETFs, LIT offers no control over the specific companies held within the fund. The composition is dictated by the underlying index. Investors seeking to focus on specific segments within the lithium and battery technology sector might find this limiting. Here's how LIT compares to some potential alternatives. iShares Global Lithium Battery Tech ETF, BLDR. Pros, generally lower expense ratio than LIT. Cons. Tracks a slightly different index, with potentially less diversification within the sector, compared to LIT. VanEck Lithium Battery ETF, BAT. Pros, lower expense ratio than LIT. Includes some electric vehicle manufacturers in the holdings, offering broader exposure beyond just pure lithium and battery technology. Cons, less liquid, lower trading volume, compared to LIT, which might make buying and selling shares slightly more challenging. Question 14. What are the potential benefits and drawbacks of investing in lithium ETF compared to individual stocks within the same sector? Here's a breakdown of the potential benefits and drawbacks to consider when choosing between investing in a lithium ETF, like LIT, and individual stocks within the lithium and battery technology sector. Lithium ETF, LIT. Benefits. Convenience diversification. ETFs offer a single investment to gain exposure to a basket of companies within the sector. This is convenient and provides built-in diversification, reducing risk compared to holding just a few individual stocks. Lower costs. Compared to some individual stocks, expense ratios for ETFs are generally lower than the trading commissions you might incur when buying and selling multiple individual stocks. Professional management, ETFs are passively managed by following an underlying index. This frees you from the time commitment and potentially complex analysis required for active stock picking. Transparency. The holdings of an ETF are transparent, allowing you to see exactly which companies you're invested in. Drawbacks. Limited control. You have no control over the specific companies held within the ETF. The composition is dictated by the underlying index. You can't tailor the investment to your specific preferences within the sector. Average returns. By design, ETFs track the performance of an index, which essentially delivers the average return of the sector. You miss out on the potential for outsized gains from individual stock picking, but also avoid the risk of significant losses. Expense ratio. While generally lower than individual stock trading costs, expense ratios still eat into your returns. Individual stocks. Benefits. Greater control potential for higher returns. You can research and choose specific companies based on your investment thesis and risk tolerance. This allows you to potentially outperform the overall sector if your stock picks outperform the average. Focus on specific areas. You can focus on specific segments within the lithium and battery technology sector that you believe hold more promise, e.g., lithium mining versus battery production versus electric vehicle manufacturers. Drawbacks. Higher costs. Trading individual stocks incurs commission fees, which can add up, especially for frequent trading. Higher risk. Individual stocks can be more volatile than an ETF, leading to potentially significant losses if a company underperforms. Time commitment. Knowledge required. Successful stock picking requires in-depth research, analysis, and understanding of the companies and the broader sector. This can be time-consuming and requires a certain level of investment knowledge. Choosing between them. Investment goals. Risk tolerance. If your primary goal is broad sector exposure with lower costs and less management time, a lithium ETF might be a good fit. However, if you're comfortable with higher risk and have the time and knowledge to research individual companies, you might aim for potentially higher returns through stock picking. Investor experience. For new investors, a lithium ETF offers a safer and more manageable way to gain exposure to the sector. Seasoned investors with a strong understanding of the lithium and battery technology space might be comfortable picking individual stocks. Portfolio diversification. Consider your overall portfolio. If you already hold individual stocks, a lithium ETF can add diversification. However, if your portfolio is heavily weighted towards ETFs, individual stock picking within the lithium and battery technology sector might be a way to gain more focused exposure. Alright, Chat ETF fam, that's all we have for today on lithium ETFs and individual stocks. Recap key points. Lithium ETFs offer convenient, diversified exposure to the lithium and battery technology sector. They come with lower costs compared to individual stock picking, but you give up control over the specific companies you invest in. Individual stocks allow you to target specific areas within the sector and potentially outperform the average return, but require more research and carry higher risk. Don't forget to like this video and subscribe to the Chat ETF channel for more in-depth investment breakdowns you can use to conquer your financial goals.